Well, Dennis, welcome to Madison, Wisconsin. So I'm here with Dennis Wagner, SBA lender, Vice President, First National Bank, based in Richmond, Virginia.
That's right.
Dennis, talk about how did you get into the SBA space, and what's your journey been like going from credit to the lending side?
Yeah. Well, first of all, thanks for having me. Thanks for having me to your house, and always a great time coming to Madison. I think this is our third year in a row doing this, right?
Yeah.
Yeah. So thanks for having me. Great to be here again. Kind of my journey with SBA has actually started right out of college. So I went to Elon University down in North Carolina, and then had the opportunity to jump right into the SBA world.
Kurt Signetti, right?
That's right.
Very contemporary side.
Yep. He was at Elon a handful of years ago, and now look at him now. So, but no, I knew I wanted to get into commercial banking. Didn't really know what exactly I wanted. I kind of pictured myself in a large market like Atlanta or Charlotte or DC or something like that, working at a big commercial bank. And this little bank called Live Oak decided to come and interview at Elon, and thought I'd give it a shot, and really enjoyed kind of the interview with them, and thought it'd be cool to live at the beach for a few years, and so got to work right out of school at an SBA shop, and wasn't servicing, moved on to underwriting, led a small team of underwriters for a few years, and
so what time era or kind of year period was this? So Live Oak now is, we're both aware, is one of the biggest banks, so not so little.
So this is back in 2013 is when I graduated.
Okay.
So I think I was employee like, I don't know, 115 or something like that. I have no idea what they're at now, but
more than that.
More than that, yeah, probably pretty close at least 5 times that if I had to guess. But no, it was a great experience working there. I fell in love with kind of the SBA world, and kind of working with small business owners and entrepreneurs, and it was just I couldn't have asked for a better way to start my career. Then I was there for I think about 5 years or so. And then, from there, I made the jump from underwriting to lending. And so I kind of leveraged a lot of the, kind of experience and expertise that I kind of developed, kind of in underwriting, and really understanding the credit side of things, and understanding deals and what works and what doesn't work.
Yeah.
And kind of leverage that to my, jump starting my lending career. So, moved from Wilmington to Richmond, where I'm at now. And it was a little closer to home for me. And my wife, we're both grew up kind of in Virginia. When I got to Richmond, it was truly like a startup. I didn't know a single person in Richmond. Nobody knew who the bank was that I worked for at the time. So it was a bank called Atlantic Capital, who ended up getting purchased, and unfortunately, doesn't exist anymore. So it was truly just a startup. I didn't know a single person. No one knew me, and so.
So what was your job at that point in time? Were you a lender? Were you doing credit stuff? What were you doing?
Yeah, so I was a lender, doing what I do now. So BDO, Business Development Officer, and so for the first, I think I started in like May or June, and for the first probably 6 months or 7 months or however long it was, I did nothing but just cold calling. Anybody who I thought could provide a lead, or kind of we could build a relationship with, and anybody who touched small businesses kind of on a daily basis is who I was targeting. So
folks like accountants, attorneys, kind of anyone kind of in and around that sphere.
Yep, exactly. Yep. So business brokers, bankers, attorneys, accountants, advisors, and I did all the networking events, like
chambers of commerce, all that.
Yep, all the above. Yep, small business development centers, SBDCs.
Yeah,
like all that stuff, and that's just what I did for the first at least 6 months, and then finally it started to get a little traction. And in the first full year, had a pretty successful year. Kind of did a lot more than I thought I would be able to do. And
what amount of loans, if you remember?
I think that first year was around $15 million.
Oh wow!
Yeah, the
That's
first
a
full year.
good number for first year.
Yeah. Like, so the first 6, I don't think I closed my first loan until like, I don't know, like right before, it was probably like a good 5 or 6 months until I finally closed my first loan.
And so were these? So I know right now you do a lot of BizAx stuff. You do some other stuff too.
Yep.
What types of loans were these for from a use of funds standpoint? Were these acquisitions, real estate deals?
It was just about anything I can get my hands on, to be honest. Kind of starting out as a BDO, at least the way I started, without kind of any sort of built-in referral network. It was basically anything I could find that was a good deal, obviously, and then we can get done. So it was some BizAx, some real estate, some franchise, some startup, some refi, and then over time I've kind of honed in on certain types of deals that I enjoy working with, and business acquisitions is by far the biggest segment of my business now. But kind of in that early, especially first year or two, it was pretty much anything that I could kind of get my hands on. But it was it was a lot of fun. Like I said, I really love working with entrepreneurs and small business owners, and kind of being a part of their entrepreneurial journey. So while it took a little while to get ramped up, it was definitely very rewarding, and still is, working with those folks.
Interesting. So I guess that's kind of a good segue. Kept talking about how now you do a lot in the BizAx space. Talk about, so when you're working with a business buyer, how do you kind of look at their professional experience in relation to what they want to buy, and trying to be able to tie those two together from the lending side? So when you're trying to tell the story for your credit team or for the analysts, how do you kind of look at linking those two things up?
Yeah, no, that's a great question, and honestly, that's probably one of the hardest parts about what we do is kind of marrying those two, the buyer experience with kind of what it will take to run the business, right?
Right.
So we don't require, and I speak for kind of our team now, like not SBA as a whole. So I want to make that clear. But my team at First National Bank, we kind of look at buyer experience as we want to see some transferable skills. So while we would love to see direct industry experience, that's just not the reality of kind of the world we live in. And most of the deals I do, the buyer is coming out of the corporate world, is coming out of an MBA program, is or a combination of both, or maybe is a U.S. military veteran, so they don't have experience in manufacturing necessarily.
So kind of back to like earlier in the year when we worked with Kevin Alvarez, who's in my Google reviews, who bought the drilling business, military background, MBA, not a drilling operator professionally.
Right, exactly. Yeah, it's a great example. And so what we look for is kind of transferable skills. So, and kind of what I mean by that is, have they managed people? Have they managed, a P&L or a budget? Do they have experience in sales and marketing? And that's huge, yeah.
Very valuable.
No matter what business you buy, you're always in the sales and marketing business. You're always selling. It doesn't matter what kind of business it is. You need customers, you need revenue.
Just like I had to sell you on coming to watch a Wisconsin football team that has a losing schedule, right? Sales is important.
Yeah, for sure. And then it depends on the business they're buying too, right? Recently I had a conversation with somebody who was an attorney, which is good. Obviously super smart guy, great with contracts, great with kind of people and communication. And then he was a real estate investor, so he had a portfolio of 3 or 4 single family resident homes that he kind of managed and did property management stuff. And but the business he wanted to buy was like a 4 or 5 location like retail operation. And so as I was talking to him, I was like, okay, well, have you managed people? Like, no, not really. Have you ever have you had to get your own clients with your attorney, your attorney, position? Well, no, I haven't done any really sales or marketing. And while I think his background would have been great for like maybe a property management company where it's all about managing properties, which is doing.
Right.
It's about contracts. It's about kind of things like that. The 4 or 5 location retail where there's probably
completely different
or 50 employees. It's a different skill set, and I just that wasn't one that we felt super comfortable with.
Right. And it's better to, and honestly, from the lending standpoint, it's better to pass on a deal that you feel like is borderline because you want to set these buyers up for success. You don't want them to fail, right? Both
Right.
for them, for you, and for the SBA.
Right.
So-
Yeah, for sure. Yeah, and doing a deal that is setting someone up for failure. It benefits nobody.
Right.
Obviously, the borrower is in a terrible position. Bank's in a bad spot.
Yeah.
So that's the last thing I want. And I would rather pass on a deal, and miss out on that production rather than put somebody in a business that I don't feel confident that they could run.
Right. Right. I mean, you have to be able to sleep at night, right? So
Yeah, no, for sure. Yeah.
Yeah.
And that's that's one of the tougher things about the job is because unfortunately deals do go bad.
Right.
We're batting a pretty high percentage on deals not going bad. But every once in a while one slips through the cracks, and it is a reality that that I like to talk with people about. Like, look, this is a it's a great business you're buying, but
Yeah.
it is a risk, and just want to make them aware of it. And
right.
so.
It's like it being a coming from not being the buyer, you're coming into a situation where there's no knowns, and then as the famous Donald Rumsfeld quote goes, there's unknown unknowns. And to the degree that you can have those variables in place, whether it's proper
Yeah.
working capital, leverage, good experience, it helps put them on a path for things to go well.
Yeah,
Hopefully.
no doubt.
Yeah. So another question for you, Dennis. So as the business buying and kind of entrepreneurship through acquisition space has grown these last several years, what concerns, if any, do you have about some of these buyers entering the space and folks where their primary motivation is more on the financial side? So think about, the amount that they're going to get at the time they sell the business or
Yeah.
the MOIC, multiple of invested capital, compared to people that really have the heart to just want to be a business owner
Yeah.
and lead a team of people. How do you kind of look at that, and how have you seen that changing these last few years as this space has really kind of emerged and gotten, more prevalence in the mainstream?
Yeah. Great question. And I'll kind of attack it in a few different angles. So some of the challenges that I've seen, especially in the ETA space, are folks coming out of just got their MBA, super smart people, guys and girls, but then they don't have that professional experience that we would generally look for. So they've got the education, which is awesome, and it's a great building block, but they haven't managed a team, they haven't run a P&L, they haven't kind of gotten their hands dirty with sales and marketing, and maybe they've been an analyst in investment banking or something like that, that kind of background,
Right.
which again is valuable experience, but that they don't have that those transferable skills.
Yep.
And so that's a challenge that I've seen more and more as this space has grown, and that's a hard one for us. And then again, just speaking for FNB, for my bank,
Yeah.
that's a tough hurdle for us to get over. The other side of it is the financial side, and they're again maybe younger, coming out of MBA, haven't had the time to build up a net worth. So they don't have a ton of liquidity on their PFS. They want to buy, a $3 or $4 million business, and without the capital to do that, they're having to raise the capital, and they're going to get, investor group put together, 4 or 5 different investors, and that investor group then is going to do, let's say the down payment is whatever, $250,000 or for the 10%. They're going to put in $240,000, and our guy's going to put in, or girl, is going to put in 10 of the $250,000. That's just not a model that we're comfortable with. We want to see our borrowers have more significant skin in the game. We certainly can work in with investors, and then we've done a few deals where we have done that. But the model we'd like to see is more like 50-50, where let's say $250,000 is the total down payment. Maybe the investors come in with $125,000. Our girls putting in $125,000 or something close to that is kind of the model that we are generally comfortable with.
Interesting. And kind of diving a little bit deeper on that, is the thought process basically that from a skin in the game perspective, so you're looking at both as cash in plus recourse rather than just as recourse? Like some lenders out there, they might be fine with 10% the 10% down coming from
Right.
the sponsor or from the guarantor,
Yeah.
and the other 90 coming from the investor group. It sounds like those are pretty evenly allocated?
Yeah, I would say so. And there's different, and every deal is a little bit different, right? So maybe one deal, or maybe our borrower has like, fantastic experience in whatever industry they're buying.
Yeah.
Right. So that industry experience, if let's say they're going to manufacturing or professional services or whatever, maybe they have phenomenal experience, and so then maybe there's a little bit of wiggle room on, okay, well, he's not as strong financially, but he's got this great industry experience, and he's bringing on, maybe his or her, father-in-law is, an executive in this space, and they're going to invest, whatever, however much money. So there's different scenarios that we can get comfortable with, and when we have, historically, but in general, we want to see our borrower have cash, into the deal.
Yeah.
Just historically, I think it's a little easier for folks to walk away if they haven't invested, their own money, into the deal. And so, if things start to go bad,
Yeah.
it's a lot harder to walk away if you've put in, 150 grand of your own money versus
Right.
if you put in 10
You feel
grand.
more connected to the business.
Yeah, exactly.
It
Yep.
is your investment.
Right.
Yeah.
For sure. Yep.
Interesting. So I want to dial in a little bit more, Kev, down that MBA path where you're, Kev, talking about from the experience standpoint and really wanting to see that someone has the chops operationally, having led teams, manage a P&L.
Mm-hmm.
So I've gone to a couple of these MBA conferences this year. I went to the UPenn Wharton conference back in the spring, went to the Rice conference back in October, and then just came back from the Chicago conference
Nice.
mid this week. And so a lot of these people, or a lot of these MBA students, they have a couple of years of experience. The analyst type or associate type in the finance space are similar. And, they go to these conferences, they get super excited about the proposition of buying one of these businesses. How should they think about how much more duration of experience they need to fit that avatar where they check that box or they can meet that bogey of what banks like you want to see or lenders like yourself want to see?
Sure. Yeah. I mean, it's and again, it is a little bit different for every deal, and and it all kind of depends on how large of a deal you want to go after, and just what background they have. So maybe they're coming from a consulting world or investment banking world or something like that, and now and maybe they have a year or two of maybe being an associate where they manage a small team. In kind of one of those settings, and now they want to go and buy, a $5 million like HVAC contractor where they have just, no tangible like carryover between what they've done,
Right.
But on the flip side, maybe instead of that, they want to buy a $1 million, professional services company where there's a lot more carryover in the types of projects they've managed, the types of people they've managed, so. It is somewhat deal dependent, but that's kind of let's say if you have a very limited time to get that experience.
Yeah,
I think that's pretty important. Kind of the size of the deal. Kind of does it match up? Does it marry with kind of your experience? Versus like let's say maybe they were they operated a family business, and maybe whatever industry, and they were kind of the number 2 or number 3 in that business.
Yeah.
And even it may not be HVAC, maybe it's I don't know, pest control, just making them one up. But now okay, well you've managed a team, maybe like more blue collar, type of employees. Now okay, and you got an MBA from from Rice or from Darden or from Wharton or whatever. Now it's like okay, that's a really compelling story to buy this $4 million HVAC company.
So just kept dialing a little bit further. So, finance experience, consulting, private equity, maybe professional service business, smaller side if you're a little bit greener as a buyer, blue collar background, military, have more experienced professional, potentially the HVACs or something on the larger side when you get to the point where you have the personal financial statement to get to that threshold of the 50% down or 50% down of the 10%.
Yeah, and again, that's kind of a formula that's kind of worked for us, and kind of get our credit folks on board and get comfortable. And I found that those types of deals have performed really well in our portfolio. And not to say that somebody in the other scenario that we talked about can't be a successful business owner. It's just all about credit risk and what each bank and what each lender is comfortable with, and and again that's kind of the formula that we found to be kind of our comfort zone.
No, yeah, completely makes sense to me. So question for you, kind of adjacent to credit risk, setting buyers up for success and wanting to make sure that deals go well. How do you as a lender look at debt service coverage, and where do you think for a first-time buyer a good kind of barometer or spot is to be there, with where people should transact and feel comfortable?
Yeah. So this is also a little bit deal dependent. So we look at let's say $1 million deal and a $5 million deal a little bit differently. So for $1 million deal, we our guidelines and our requirements aren't quite as strict as for the larger $3, $4, $5 million deals. Just in general, the larger the deal, the larger the unsecured exposure, the better the deal we want. The better debt service we want, better experience, better post-close liquidity.
More dollars at risk for the bank, for the
Correct.
SBA, and for the buyer.
Correct. Yeah, exactly. So I always aim for a 1.5 times debt service coverage ratio. I think SB minimum is 1.15. I want to say a lot of kind of a standard out there is 1.25.
Right.
Sometimes we can get comfortable with the 1.25. Just personally, I think that's just a little tight because once a buyer gets into a business, something's going to go wrong.
Right.
Right. Whether it's an employee leaves, you lose a customer, one of your trucks breaks down, your roof caves in because of some random storm, or something like that. Something is going to happen. And if you're underwriting deals, if you as a buyer are buying deals at 1.15, 1.25, that just leaves you with just such a little wiggle room, to kind of persevere kind of through something like that happening.
Right.
So personally, I like to see 1.5, no matter what the deal size. And then for the bank, the larger the deal, probably the more debt service we're going to want to see. And so, but kind of baseline 1.15 is kind of what I look for.
And so 1.5, that's kind of where you as the lender feel comfortable, or that's what the bank would want to see regardless of deal size? Like, would $1 million deal for you as a lender at FNB, would that be 1.5 as the requirement to get it across the board?
So we would, like, for anything under $1.5 million is kind of our threshold. We would be okay with 1.25. That's kind of our minimum standard. And so I can, and we have done some deals, where maybe the buyer experience is good, is better, or maybe it's a really industry we really like, or there's some other factor at play where we can get comfortable with 1.25 deals. But probably once you hit that 1.5, 2 million mark, 1.5 times is kind of generally what we would look for.
Smart. Yeah, and Kev, going down that path too, what I always told people, well, for Pioneer, the minimum debt service coverage that we'll get involved in a deal is 1.25 because we want people to succeed. We don't want deals not performing to be tied to that deal, but back to the buyer. I mean, if one of these things defaults, it can destroy someone's life.
Right.
Unfortunately, people commit suicide and terrible things happen when deals go sideways. So,
and there are a few levers we can kind of play with to that influence debt service coverage. One part of the equation is the performance of the business, and there's not much you can do there except maybe, sometimes there's add backs are a little marginal, or maybe we could kind of stretch on an add back or two here, but for the most part the performance of the business is what it is, right? So there's not much we can do there. But the two factors that we can control to some degree, or we kind of play with, is one is how much that impacts debt service coverage, is how much salary that the buyer needs to take out of the business. And one thing that I've found that can really positively impact that is having a spouse or any sort of outside income that will continue after the acquisition. So that relieves a lot of pressure from let's say based on your taxes and your mortgage and your car payments and your student loans,
right?
You need $10 grand a month to live, to maintain your lifestyle. And that adds a lot of pressure. If you as a buyer buy a business, you need 10 grand a month at a minimum just to maintain what you've got going on.
Yeah.
So you need to take that out of the business no matter what, or you're going to start.
Talk about that. Sorry to jump into this. Talk about that a little bit more from a standpoint of, so, say you have a couple, they're married, and the spouse that's not buying the business, they have the salary that's there, but if they're not a guarantor or signer of the loan, from the bank perspective, you can't count that salary even though you know it's there. So talk about how that works from a global cash flow standpoint, and is that a bank discretion thing where they can factor in that spouse salary even if they're not signing on the loan, or is that a SBA mandate?
No, yes, great question. And it is a bank. The SBA does not have a mandate on whether or not a spouse needs a guarantee if you count their income. And with that being said, I guess we don't require the spouse to guarantee. Some banks do, some banks don't. But with that being said, we're never going to count the spouse's income to make our debt service over 1.25, 1.5. But what we can do is we can reduce the amount of salary we need to show our buyer taking out of the business. Let's say you have a spouse that you need 10 grand a month, kind of use my previous example to just live, right?
Right.
And let's say your spouse makes, 7 grand a month or something like that. Then, okay, well, you're making 70% of your 10 grand. So we need to show you making 3 grand a month or 36K per year, or, whatever the case is, to lend. So, instead of, hitting your debt service coverage with a full $120,000 annual salary, then we can do, $36,000 salary, which, can be impactful, especially the larger or I guess the smaller the deal is, and the less cash flow there is to go around. On a $5 million deal with $1.2 million in cash flow, that 70 grand's not going to make a huge. I mean, it makes a little bit of difference,
right?
But on a $1 million deal where the SDE is maybe 330, that 70 grand goes a long way.
Yeah,
it's a pretty big swing.
Hopefully, if someone's only paying themselves 3 grand a month, they're not living in New York. I mean, this person can be out in the streets very quickly.
Yeah, well, and that's the thing too. It's that's not you can't. We're not saying you can't take more than 3 grand a month, but for our underwriting, okay, what do you need baseline to just continue living your current lifestyle?
Yeah.
And if that's your spouse makes 7, you make 3 to add up to 10. Great. Yeah. Or if you don't have a spouse, or your spouse doesn't work, or whatever, and you need the full 10, then we hit it for the full 10. So that's kind of the mindset we have on it.
Yeah.
It can be on the flip side, it can let's say you don't have a spouse that works, and you have a big mortgage, and you have a bunch of kids, and you have very expensive car payments, and now instead of 10 grand a month, you need 20 a month.
Right.
And that.
Or if you're a member at a country club or something like that, it all adds up, right?
Yeah,
Super
for
quickly.
sure. Yep.
Yeah.
So that's one kind of factor that kind of we can have some control, or not control, but the situation can be different for different couples and different people. And then the other one is a seller note, how you're structuring the deal, right?
Right.
So and again, this is more not an SBA thing, more of a bank thing, but for us, if you're able to structure your seller note with a 2-year standby, that gives us a lot of comfort in underwriting.
Can you explain what a standby is? So it's something that I know, but for someone watching this that might not be familiar.
Yeah, for sure. So when I say standby, I mean no payment on that loan and then the time frame we look for is 24 months. So no payment for the first 24 months on the seller note. And we like that for 2 reasons. One, just historically, the most vulnerable time in an acquisition is that first 24 months. That's the transitionary period where the buyer's taking over, seller's exiting. Maybe an employee leaves, maybe a customer leaves, maybe there's some disruption in changing systems, or whatever the case is. And so any relief we can get the buyer in that initial kind of 24-month period is a pretty big bonus. And then also, we don't need to count that, that debt service, kind of in our cash flow calculations.
Yep.
And so when I'm looking at a deal and it's really close to that 1.25, or maybe 1.5, it's a larger deal. That's kind of one of the factors that okay, well, maybe we can structure it with, instead of having a seller note on a 5-year term where your monthly payments, $5 grand a month, maybe we can throw a 2-year standby on that, kind of give you some payment relief in that initial 2 years. And then now our debt service looks a little stronger. There's more of a buy-in from the seller.
And so then after that, so after the 2-year standby, do you recommend if people can to try to go, standby interest only, then P&I, or 2-year standby, then P&I? Because in the circumstance where if you're doing the standby to hit the debt service coverage bogey, if they can't grow the sales and if things kept stay steady Eddie, then all of a sudden the debt coverage post that period would dip a little bit.
Right. Yeah, and that's a good point. So my recommendation, and I can advise on, the loan perspective, like, hey, here's kind of what would work from a financing perspective.
Right.
I'm not an investment advisor. Like, I don't give investment advice. Like, hey, do this because it's a great deal, or do this because of it's a great investment, so there is somewhat of a delineation there. But what I've seen, just generally, is that the longer the amortization you can get, the better. Just to kind of have some smaller monthly payments. So like the standard seller note that I see out there that does get a 2-year standby is like 2-year standby followed by kind of 3 to 5 years of repayment, and then a balloon at some point 3 or 5 years after that standby period. And so that kind of gives them the maximum flexibility. Maybe you have an amortization of 10 or maybe even more, 12 or 15 years. So monthly payment's a little lower. And then at the balloon, you'd have some options. Either you can just re-up with the seller, or if things are going great, you can maybe refinance it, with an SBA loan or conventional loan. Or if things are going really great, and you've grown the company 20% like you thought you would, then you can just pay it off with cash. So that's kind of I would say like the standard, structure that I see. And I think it gives the buyer the most flexibility too.
It's kind of interesting the 2-year standby. So what I've typically told buyers or coach buyers to do is to have a payment on the seller's note, even if it's $1 or $5 out of the gates, with the rationale being that it has a negligible to no impact on the debt coverage, but then it makes that seller's note eligible to be refinanced after the 2 years of current payments. And so when you get to the point that you have the balloon, even if things have been a little bit bumpy, you accomplish similar to what you would do if you had it on the full standby for the 2 years, but all of a sudden it's eligible to recapitalize, such that if you have a balloon payment at year 4, even if it's amortized over 8 to 10 years, at that point you have the optionality that you could go back to the bank to refinance it out.
Right. And that's a good point. And that I do recommend all buyers to have the balloon no shorter than 5 years. So let's say we're doing a 2-year standby,
because you're gonna inevitably have some type of J curve or surprise. Get back to your prior comment.
And so that way, if you have a let's say balloon at 5 years, then you have a 2-year standby and then 3 years of repayment. Which, to your point, you need 24 months to be eligible to refi a seller note. So that way they have 24 months of payment after the standby, and then they got a full 12 months to figure out kind of what they want to do.
Right.
So whether it's hey, things are going great. I've grown the business 20% a year, and I'm sitting on a pile of cash, and I can just pay it off. Or hey, let me reach out to my SBA lender, see if they can recapitalize and kind of refi the seller note. So really good point.
Talk a little bit anecdotally, Dennis. So on the so seller's notes are always an interesting topic of discussion because everyone does different things, right? And it's it's essentially what's the buyer and the seller both agreeable to, then what does the bank want to see, and you're trying to kind of triangulate these 3 different parties to make it work, right? To make the deal structure work. Talk anecdotally about when you've seen people that have done an acquisition either with your bank or someone else, and they're coming to you and they want to refinance at the seller's note. When business is going well, when things are profitable, is there any circumstance where the bank would not refi out the seller's note if it's been paid current for 3 years? Just talk about that kind of anecdotally from what you've seen.
So interesting enough, I haven't really seen a whole lot of seller note refi requests, especially when paired with an SBA loan. I've seen a few, and I've done a few where that's how the buyer bought the business with just seller financing, or maybe down payment plus seller financing. But I haven't done a whole lot of deals where I'm, let's say the seller holds back 10 to 20%, kind of like a standard SBA deal, and now we're coming in to take out the that seller note. And I think part of that is because if you as a buyer, buy a business, the SBA, and you're using SBA loan, of course, is kind of the assumption.
Yeah.
The SBA loan is going to have a first lien on all business assets.
Right.
And then basically the seller note is secured by the leftovers. So you can put a second lien on it. Maybe they get a personal guarantee from the buyer, but in reality, it's subordinated. It's well behind what the SBA note is. And so for a new SBA lender to come in and take over the second note, that would mean they have to be comfortable with being behind that first SBA lender.
So realistically, they would have to refinance the SBA loan with the seller's note. So I guess kept pivoting the question. Let's say it's an existing customer and they have the first lien debt with the bank that they're going to. When would a bank not be comfortable refinancing the seller's note? So say it's the seller's note's on a 5-year amortization, the buyer's 3 years in, and they're like, well, why not stretch this out over 10 years instead of having it be on the 5?
Yeah.
Would it be like just, macroeconomic environment isn't good, we're in kind of tariff world, or like, how would you think about that?
Yeah, and you're asking, like, if one of the deals I did were to come back to me in 3 years or whatever. Yeah. So, I mean, I would say we would look at the historical performance of the business and, you've been running it for 3 years now. Has revenue gone up? Has it gone down? Is it stable? What's cash flow looking like? What have the trends been looking like? And so, those are definitely things we would look for. If they're in their projections with our first deal, hey, I'm going to grow this thing to the moon and I'm going to grow 25% a year and, going to implement all these things. And we would kind of go back to them and, all right, well, have you implemented these systems? Have you done these new marketing channels? Have you captured more, of X, Y, and Z, market segment?
Yeah.
And if the answer is like we've done all these things and we've grown the business nicely, then, as long as the numbers worked, I don't see a reason not to do the deal. But on the flip side, if it's like, hey, you projected to grow 15% a year, but you're down 10% since you bought it, your your cash flow is constricted a little bit, you haven't really done what you said you were going to do, then those are generally deals that are challenging to get done.
Right. So like in the former scenario, if things have gone well, from your perspective as the banker, as the lender, the seller's notes have served its purpose with helping to make the transition go well.
Yep.
And so at that point, it's like, presumably speaking, if you re-amortize it out, even though as the bank you're taking on more debt, it frees up more cash flow for the business. So hopefully I have to reinvest back to make things go well. I'm doing the weird hands thing.
What do I do with my hands?
Right.
But no, you're exactly right. Yeah. It would help free up some cash flow. Then it would also kind of get, if they do have a balloon coming up, then they get out of that kind of situation where okay, now I've got $200,000 that's coming due in 6 months, and we're gonna have to figure that out. So refinancing a seller note makes a ton of sense, especially if the business is going well, and things are progressing upwards versus downwards, which is unfortunately always challenging to get this done with negative trends.
So one more question back to the down payment. So kind of thinking about different ways to come up with the down payment. There's buyer cash. You can bring on investors. And then in the current state of the world, post June SBA guideline changes, they brought back where you have the option technically to do a seller's note and full standby. Yep. Which I probably own the trademark too.
Yeah.
For up to half the hat. Yes, the good old hat. For up to half the 10% down. Let's say in the margin, Dennis, you have a very well capitalized buyer, and they have the ability where they could do 10% down all as cash, no investors. Let's just call the 10% down $200,000. And so they could either do that all as cash, or technically they have a seller that's agreeable to extending half of that 10% or $100,000 as a full standby seller's note, and the buyer would contribute $100,000. From the standpoint as the banker, like all else equal, would you rather see the buyer put in the full 10% as cash, or have that as post-close liquidity? How do you kind of think about that?
Yeah, great question. And again, like most of my answers, it is a little bit dependent on the deal. So I'm kind of putting that disclaimer out there. But all things being equal, I think we would prefer to see some extra post-close liquidity. If the seller's willing to do a full 10-year standby, then generally we have been okay with that being a part of the capital stack or part of the down payment. So, and there's always a balancing act too, right? I mean, if we're working with a buyer that's got $1 million in, in liquidity, they can easily put in the 10%. We would probably be more apt to want to see them, kind of do the 10%, and then maybe a selling on top of that, but if we've got a buyer that, let's say they have 200, exactly 200, like we always want to see post-close liquidity. And so that could be a great way to kind of, preserve some liquidity, keep it on the balance sheet, in case, something happens after closing.
And what percent ideally for post-close liquidity do you like to see when possible relative to the loan amount?
Yeah, so I think we look at this in a pretty interesting way. We don't really have a set percentage of like like 10% of the loan amount, is one of the standards kind of I've heard. We don't really have a set percentage necessarily. We could kind of look at each buyer and their individual situation. So we look for somewhere between 3 to 6 months of personal living expenses that we want to see as post-close liquidity. So again, it kind of goes back to who your buyer is and kind of how expensive their lifestyle is. Like if you've got somebody that they need 10 grand a month to live, probably somewhere in like the 50 grand range is where we would feel comfortable. If you've got somebody that owns a $2 million house and got a bunch of student loans and a bunch of boats and cars, and they need 25 grand a month, we're probably gonna want to see at least 100 grand, and then also it kind of is dependent on the deal size, right? I mean, if we're looking at $1 million deal, we're probably comfortable with that. $2 million, probably comfortable with that. If we get up in the $4 or $5 million range, probably gonna want to see a little bit more, a little just stronger deal overall.
Right. Sell that house and buy a bigger business. I mean, houses are expensive.
They are, yeah.
So
no doubt.
Yeah, so a couple more questions here, Readiness. What is your personal outlook on the business buying space in kind of the ETA land for the next 3 to 5 years, with kind of where you've seen things going directionally, different buyers getting into the equation, the macroeconomic environment, things like tariffs? Are you bullish? Do you have a positive outlook? Do you have any big concerns? Where's your mind, Kevin, from the lender purview?
Yeah, I mean, I'm very bullish. I have a very positive outlook, kind of on the next 3 to 5 years, in the acquisition space. It's becoming a lot more mainstream, than it was, even when I started, 7 or 8 years ago, or whenever it was, lending. So it's become a lot more mainstream, a lot more people talking about it. There's all these, different groups out there, different ETA clubs, different, MBA programs specializing in ETA. And so I think there's a lot more kind of just notoriety out there about it, which is good, and it can be bad. I think there's a lot of kind of misinformation out there too on
bad always comes with the good, good always comes with the bad.
Yeah.
Unfortunately.
So I think some of the risks that I see, are some of the it's kind of like a lot of things. Kind of a few bad apples can kind of ruin it for everybody. Ruin the bunch.
Yeah.
So if we do start seeing some people that are trying to skirt the SBA rules, or trying to just be too thin with their deals, and like we start seeing more defaults in this space, I think that could be something that hurts the environment as a whole, because that could change, cause the SBA to change policy. If all of a sudden the SBA sees, oh well, a lot of these like ETA deals are starting to go bad because the buyer's able to walk because they're raising 100% equity, or whatever the scenario is.
Yeah.
And it may cause the SBA, okay, well, we need to tighten down these guidelines, and so that's probably the biggest risk that I see, is just people being a little too aggressive, and that causing the SBA to kind of rein back what we're able to do in the space.
Right.
So hopefully, I'm not expecting that to happen, but if I had to choose kind of a risk, or something that I'm keeping an eye on, that's probably one.
Yeah, I mean, I personally have a positive outlook too. I think the recent guideline changes, net, I think are going to be for the better. Insofar as now, I think the buyer you have coming into this space is going to be more capitalized. I think banks have also kind of evolved their credit policies to be sympathetic with those guidelines, and there's more working capital typically going to deals. My concern is kind of adjacent to this, as there have been more things like ChatGPT and AI out there. You now have buyers that are putting in the SBA guidelines into ChatGPT, trying to find edge ways to do deals, and trying to get cute with things like multiple holding companies, and like where you can't even trace back the beneficial ownership to the specific individuals. And one of my team members sent me a case where a prospect had reached out on it, and I looked at the thing, I read it for 10 minutes, 3 different times, and my chief operating officer looked at it, as like, I can't even figure out who owns this company. This is just
Yeah.
too confusing.
Yeah, yeah, for sure. And generally speaking, the simpler you can make your structure, the better it fits with SBA. Like,
Oh,
I've
completely.
I've seen some stuff like that too, where it's just like,
Yeah.
like what are you doing? Like,
Right.
who is giving you this advice to structure it this way?
Right.
But
It's one thing if you have, like investor group where there is one holdco and then
Yeah.
you have Dennis, Matthias, and two other people that are the beneficial owners. But it's like the more complex you make it,
yeah,
it thins out the pool or the number of banks that want to do the deal.
hmm
And that just makes everything more expensive and more time consuming.
yeah, for sure. Yeah. The more time that we have to have our attorneys looking at it, the more money obviously that comes out of the buyer's pocket ultimately. And the reality is, a lot of times these super complex structures
Yeah.
just aren't necessary for
Right.
what we're doing here.
What I tell my team is like, if you can't explain it to a fifth grader, it's too complicated.
That's
So-
a good. Yeah, I mean that's a good way to put it.
Yeah. So last question is, and thanks for joining me here on the podcast. If you could give one piece of advice to a prospective business buyer, current business buyer, prospective, before starting the search to buy a business, what would it be? Things like experience, saving up more capital, some combination of the two, or something completely different.
Yeah, I would say be able to articulate your story really well. Be able to articulate, okay, what have you done historically that makes you a good fit to buy this business? Because I work with so many people that just can't really do that, and then they can't put that story together, and so it makes it really hard for me, to either one, get comfortable with what they're doing, and then two, get comfortable enough to to pitch it to my credit team. Because if I don't believe in it, I'm not going to send it up to our underwriting team. And so I would say really have just a really good understanding of what your strengths are, what your weaknesses are, how you're going to mitigate those weaknesses. Maybe you have great experience, but a lighter PFS, or maybe vice versa. You have a great PFS because you've been really super successful in your career, but maybe you don't have experience in the certain sector you're looking to buy, or whatever. But just have a good story and a good narrative on why you're the right deal, or why you're the right buyer for this deal. And that makes them easier for me to believe in, and then that makes it easier for me to pitch it to my credit team and kind of sell that story to them.
And with that story, that kind of dovetails into like the business plan and really
Yep.
kind of fleshing out those details.
Yep, for sure.
So that it's kind of both the intersection of the business and the buyer, and how those two really meet.
Yeah, no, exactly. Yeah, strong business plan is important. We look for business plan and projections, on all of our deals. The SBA doesn't necessarily require it, but my personal thought is, like, if you can't put a business plan or projections, like, how are you going to run the business?
Right.
Like, if you don't, have a good understanding of what you're going to do, even if it's not really changing anything, but if you don't have a good understanding of what the business does
Yeah.
and how you're going to fit into it, then, how are you supposed to, how are we supposed to get comfortable, lending, $1 million, $3 million, $4 million, whatever.
And there are so many different resources out there too, like these small business, the SBDCs and similar, where if someone, I mean, not everyone is a finance person, right? You might
Sure.
come from a military background or like a marketing background, but you can find these resources, fractional CFOs, the SBDCs and similar, and work have hand glove with them to get
Right.
the materials that you need.
Yeah, no doubt. Yeah, there are tons of resources out there. I think I always kind of plug the SBDCs. They're a free service that the SBA provides. They help with business plans, projections, all that good stuff. But yeah, like fractional CFOs, accountants. Like it's really important. We didn't really touch on this, but to have a really strong team in place as well. I guess that's another thing. Have an attorney, that you feel really comfortable with, that has done, transactional, M&A kind of stuff, preferably with SBA attached to it. Have a good, due diligence team, CPA, if you want to do quality of earnings report, like having a good advisor, with Pioneer Capital, having a good banker, that specializes in SBA, that does business acquisitions, that understands the space.
Yeah.
So having a good team in place, I think, is really important too, and a good team will help you kind of, maybe prepare some of that stuff as well.
Super helpful. What's the best way for someone to get in touch with you if they're watching this podcast, interested in learning more about First National Bank, your lending area, and seeing if they're a good fit to work together?
Yeah, for sure. I mean, I'm an open book, so I'm fairly active on LinkedIn. So certainly can reach out there. I think my email address and my contact information is on LinkedIn. So yeah, shoot me an email, a text, LinkedIn message, whatever. I'm always happy to have a conversation. Even if you're not close to an LOI. I have conversations with tons of folks that are early stage. And just kind of, hey, I've learned about this. I'm interested. Maybe talk to me about what the SBA is. I'm always happy to have those conversations. Even if it doesn't result in me getting a deal, I like being a resource and helping people when I can. So
Yeah.
yeah, I'm an open book, and you can find me on LinkedIn or email, cell phone. I'm not sure, if you'll publish that or not, but yeah, reach me however you feel most comfortable with.
Awesome. Well, appreciate you joining my podcast.
Yeah,
and
man.
Excited to watch some football.
For sure. Me too.
Awesome.